You check your bank account. The number is smaller than it should be. You just got paid 4 days ago. Where did it go? You didn't buy anything crazy. A few subscriptions renewed, a late fee snuck in, interest quietly ate a slice you never saw move. You tell yourself you'll save more next month. You've told yourself that before. Here's the strange part. It's not your fault. And it's not an accident either. The real answer is far stranger than bad budgeting. The system you're living inside was never built to help you keep money. It was built to move money. And the difference between those two things is the whole story. Start with a simple question. Why does saving feel so hard, even for smart, disciplined people? For decades, economists assumed the answer was willpower. If people just tried harder, they'd save more. But in the early 2000s, behavioral economist Richard Thaler, working with Shlomo Benartzi, tested that assumption directly. They designed a program called Save More Tomorrow. Instead of asking workers to cut their spending today, the program asked them to commit future raises to retirement savings automatically before the money ever touched their hands. The results were staggering. Saving rates nearly quadrupled in some workplaces, not because people became more disciplined, because the money was removed from temptation before temptation had a chance. That single finding revealed something uncomfortable. Your willpower was never the problem, your access was. Every dollar that reaches your checking account is a dollar exposed to friction. Notifications, one-click checkout, buy now, pay later at the register. The system doesn't need to trick you into spending, it just needs to keep the money close enough to touch. So who designed it this way? Nobody, really. That's the twist. There's no secret room of bankers rubbing their hands together, deciding to keep you broke. What happened instead is slower, and in some ways worse. Over the last century, the financial system evolved around a single incentive. Money that moves generates profit. Money that sits still generates almost nothing for anyone but you. Think about what a bank actually does with your savings account. It doesn't lock your money in a vault. It lends it out, multiple times over, collecting interest on loans far higher than the interest it pays you. Your idle cash is raw material. The entire architecture of modern banking rewards circulation, not accumulation. Now widen the lens further back. Before the 1970s, most currencies were tied to gold. There was a hard limit on how much money could exist. That changed in 1971 when the United States ended the direct convertibility of the dollar to gold. Suddenly, currency could expand without a physical anchor. This wasn't a scandal. It was a policy shift, debated openly, defended by serious economists. But it had a quiet side effect. When money supply can grow indefinitely, the value of money sitting still slowly erodes. Inflation isn't a glitch in the system, it's a built-in tax on stillness. Does that mean saving is pointless? Not exactly. It means saving alone, without understanding the system around it, quietly loses to the system every time. Here's where the story gets even stranger. Nobel laureate Daniel Kahneman spent decades studying how humans make decisions about money, alongside his research partner Amos Tversky. Their work on prospect theory showed that people don't evaluate money rationally. Losses hurt roughly twice as much as equivalent gains feel good. That single asymmetry, loss aversion, shapes almost every financial product you interact with. Credit cards exploit it by hiding the loss. You don't feel $40 leave your hand. You feel a small tap, a satisfying beep, a receipt you barely glance at. The pain of spending is engineered out of the transaction, while the reward of buying stays fully intact. Subscription services exploit the same bias in reverse. Canceling feels like a loss of access, of identity, of a habit you've built. So the subscription renews, quietly, month after month, and you rarely notice until you audit your statements line by line. Is this manipulation, or is it simply business, understanding human psychology and building around it? The honest answer is both, and the line between them is blurrier than most people want to admit. There's one more piece to this puzzle, and it might be the most important one. Economist Anna Maria Lusardi has spent much of her career researching financial literacy across dozens of countries. Her studies consistently find the same pattern. Most adults, even in wealthy nations, cannot correctly answer basic questions about interest rates, inflation, and risk diversification. Not because people are incapable of learning it, because it was never systematically taught. Financial literacy isn't a mandatory subject in most school systems. Compare that to how thoroughly a teenager learns to calculate the area of a triangle, a skill they may use twice in adult life, against how little they learn about compound interest, a force that will shape every major decision of their financial future. Is that an oversight, or is an undereducated population simply easier to lend to, easier to upsell, easier to keep circulating money through a system that profits from the movement? You don't need a conspiracy to explain that gap. You just need incentives that were never aligned with teaching you to opt out. So where does that leave you standing here? Staring at a bank balance smaller than it should be? Not powerless. Just informed differently than before. The system rewards circulation because circulation is where profit lives. For banks, for lenders, for retailers, for advertisers. It was never designed with malice toward you specifically. It was designed around an incentive structure, and you happen to be standing inside that structure every time you tap your card. But the same research that exposes the trap also hands you a way through it. Thaler and Bonartzi proved that removing friction from saving works better than fighting temptation directly. Automate it before the money reaches your hands, the same way your raise gets automated into spending before you ever adjust to having it. Kahneman's work on loss aversion means you can use the same psychological lever in your own favor, framing savings goals as protecting something you already have rather than sacrificing something new. And Lusardi's research is a reminder that financial literacy isn't common sense. It's a skill deliberately undertaught and deliberately learnable anyway, starting today, starting with you. None of this makes the system fair. It wasn't built to be fair. It was built to move. But movement isn't only something that happens to you. Once you see the architecture clearly, once you understand that your paycheck was never disappearing by accident, you can start redirecting the current instead of just riding it. You check your bank account again, the number is still smaller than you'd like, but this time you know exactly why.